Hello again, everyone, and welcome to Quigley on Divorce, a behind-the-scenes look. I'm your host, James Quigley, and I'm pleased to present a very special guest today, Bruce Richman. And Bruce, before you give the viewers and listeners a little background about who you are and what you do, I'll preface today's conversation by saying that Bruce has been a business valuator and a financial expert in many, many cases throughout my 27 years of practice. I think the first involvement we had working together probably goes back a good 20 to 25 years ago when you did a sort of a neutral valuation, weren't hired by either side, but came in and did what we call sometimes a down and dirty analysis, which you can talk about. But then I think one of the biggest cases we had was where you were hired by the other side. And we tried a very, very large financial case out in DuPage County. And the irony of ironies is that even though you opposed us on that case, you never testified in that case because you and the other business valuator came together, analyzed each other's work, and came up with a number that you both agreed upon to avoid any experts having to testify at trial. And so that's something else we'll talk about in terms of business valuations in divorce. But first of all, for the viewers and listeners, give them some background on who you're working with, how long you've been doing this, some of your background experience.
I'm Bruce Richman, and I am a CPA, but I'm also certified in valuations. I'm also a certified forensic examiner. So my work has been in the divorce arena, not only doing valuation work, but all financial aspects of divorce. And I've been doing this for over 25 years.
Don't date yourself.
Though I probably do look younger than Jim. But the involvement has been, as I say, all financial aspects, because in divorce is a unique area. In doing valuation work, it's not only being an expert in valuation, but also understanding the issues that are involved in a divorce case, because the valuator can add a lot more to the case and assist the attorney beyond just that valuation, since they're already looking at the financial aspects while doing the valuation.
And that gets into some questions of when you have business owners, income, maybe dissipation, lifestyle analysis, all of which you've been involved in. For today's conversation, I want to talk about specifically business valuations within a divorce context. And I know that that's a very technical area. You have to have specialized training and knowledge, which you do. And we as divorce lawyers rely on people like you very heavily when you have a business owner in a divorce. So as a starting point, when someone picks up the phone and calls and says, hey, listen, we've got a business that's going to need to be valued as part of a divorce. First, tell the viewers and listeners in what context you can be appointed. Is it always one side or the other? How does it work in terms of you actually getting involved in a divorce case?
That's actually a very good point, Jim, because in today's environment, we can get appointed by a court to be a neutral where we report to the court. We can be hired by one spouse versus the other spouse, or sometimes we'll refer to that as the non-propertied spouse or the propertied spouse. Mm-hmm. Or we could have both attorneys agree that we'll be engaged as a neutral for both parties.
Sure. Let me ask you, and that sounds like maybe if you could be appointed or brought into a case in different ways. As a business valuator, does that change anything you do in terms of how you value business?
No, not at all. And sometimes we'll be hired where there is someone else doing the valuation. We'll be hired as a consultant for the law firm to review the work that's being done.
So in other words,
in either case, it doesn't change the work that we're doing.
Okay. And so in that context, you could also come in where either the court has already appointed a separate business valuator, or maybe the other side hired someone to do a report, and you sometimes come in to look at the report itself to see if it checks all the boxes in terms of what a business valuation should do.
Absolutely. And sometimes that helps settle the case where there might be a valuation and we're coming in to assist counsel in reviewing that, giving them guidance as to what are the questions they ought to be asking. And was this valuation prepared at a proper level? We'll evaluate that and assist counsel so that they can work with the other side to possibly get the case settled.
Okay.
And sometimes I might work as, quote, a mediator in getting the parties together to get this settled, as I'm certified in mediation as well.
Okay, well, interesting, good. So let's kind of hypothetically walk through this. Let's say in the context of the court appointing you as the court's witness, you're now coming in and there's a business to be valued. I guess my first question is there a standard that you are going to apply in terms of valuing a business in the context of a divorce versus maybe, valuing it for a private sale or something along those lines?
Very good. In Illinois now, as we all know, the standard of value is fair market value.
And explain in layman's terms kind of what that means.
Fair market value, by pure definition, is a willing buyer, willing seller, neither under any compulsion to buy or to sell, and all having knowledge of all of the facts. So in essence, when we break down that definition, we're dealing really with a hypothetical willing buyer and willing seller, because a sale may not necessarily really be taking place.
Sure.
And as we know, a lot of clients will say, well, but I'm not selling my business.
Right.
And that is true.
Sure.
But the fact is that the courts have to determine how to allocate a marital estate. So you need to come up with a value of the assets of the marital estate.
So the standard is really looking in boiling down. It's really like as though there is a hypothetical arm's length transaction. In other words, you look at it as though one of the litigants in the case owns a business. And let's say I would like to buy that business as a hypothetical buyer. What would I pay, based upon your analysis, if I were to buy that person's business?
Well, that's a question that's usually raised. and I'll give you my response in that if that buyer wants to pay fair market value, this is the value that he would pay. Because if you're looking at a specific buyer, you no longer really have fair market value. You may have some other type of value. Could be strategic buyer, and that value could be different. But for purposes of Illinois, our standard is fair market value. So it's a hypothetical willing buyer, willing seller, not a specific buyer.
So when you talk about strategic value, I mean, when you're now getting into private placement deals where maybe someone comes in and they're going to buy a distressed business because they're going to tear it apart or build it back up and resell it later. That's totally different than I'm just buying that business at its fair market level.
Yeah, sometimes you could look at it like a financial buyer who has no particular interest, as opposed to if I was in the widget business and there's another company that's in the widget business and has a lot of capacity and wants to buy our company, they may be willing to pay more for it than, say, a financial buyer, because they have a particular interest involved in wanting to do it.
Understood.
So a fair market value, that buyer is really, it's hypothetical, willing buyer, willing seller, and it's not a specific buyer.
Okay. I want to get a little bit technical on some of what you do as a business value, and I want to understand methodology in a general sense. I want to understand, included in that, goodwill discounts that maybe it would apply, and so from before you even get into the analysis part, what is it you need as a evaluator to really get a sense of, and what is it that you do in a general sense?
And usually, one of the first things that we'll do is get an understanding of the type of business that we're valuing.
How do you do that?
In today's environment, it's easy to go online and get an understanding of the industry. One advantage of doing this for a long time, you have a pretty good understanding of a lot of industries.
Yeah.
My next step then is to use that knowledge, put together what I call a document and information request,
okay,
which will ask for certain financial documents, like financial statements. They could be audited, compiled, or reviewed financials. They could be internal financial statements, because not all companies use an outside accounting firm for financial statements.
Okay.
We'll ask for detailed general ledgers. We'll ask for tax returns and get an understanding, enough of the financial information so that we can analyze what the business is, what's going on in the business. The next step, once we get these documents, is to do what we call a site visit and a management interview.
And what is that?
A site visit is a very important part of the process. It is going out to the company and taking a look at the company. You know, famous saying is a picture is worth 1,000 words.
Yeah.
Well, it's so true. It's going out and kicking the tires, taking a look at the company.
Physically
out to the company.
Sure. Okay.
And taking a look and see how they operate. Does it appear to have a lot of capacity? Is their equipment worn down, or is it new? Looks like a well-efficient operating company. We'll then follow that up with management interview.
Okay.
And be able to get an understanding of the actual operations of the company.
When you say management interview, is that the litigant? Oftentimes, in other words, the litigant is the business owner, or at least a part owner. And so can you really garner much by talking to that owner, or does it just depend?
Well, it depends. Sometimes doing this a long time, you get a pretty good sense of whether you're getting a straight answer or not.
Yeah.
But also, we'll get that supported by possibly talking to other people in the business. Could be the partner, if they don't own 100% of it. Could be talking to someone who is the general manager or the operation manager or the head of sales, that will corroborate what is being said by the owner.
Okay.
And then also looking at the financial data. Does it support what they're really saying? The owner will say, times are tough. It's really bad out there.
Okay.
This business is about to go under.
By the way, you've never heard that in a divorce context.
No, never. And then you look at the financials, and sales are going up 20% a year, and margins are going up, but yet they're on the verge of dying.
Yeah.
So it's not just taking somebody's word, but putting it in context with your full analysis.
Got it. Let me go back to the fair market value concept, because you mentioned, just as an example, a business that's manufacturing or selling widgets. Okay. Does it make any difference in terms of the standard or the methodology that you apply as a business valuator, whether you're valuing a widget business, a dental practice, any other type of business, or is it sort of the same approach regardless of the nature of the business you're valuing?
In general, I would say yes. From the sense that typically we're going to look at three approaches,
okay,
which would be a income approach, a market approach, and a asset approach.
Okay. And can you kind of break those three approaches down?
And within each of those approaches, there's methods. So there's a difference between a method and an approach. So for example, in the income approach, there are two typical methods that we use, which would be a capitalization of earnings, and there would also be a discounted cash flow method.
Break those two concepts down again, just assuming some of our viewers and listeners don't have the technical jargon down in terms of that type of methodology.
When we look at valuation, valuation is a forward-looking process. Someone who is looking to buy a company is looking at the forward. What is the earning stream that you anticipate to get from this company?
And this is part of the income analysis.
There's income analysis. So what the first step then in determining what is that potential earning stream that we're going to get, we have to what we call normalize that earning stream. Just because you see the earnings stream on the tax return or the financial statement isn't necessarily the earning stream as you as a potential owner of that business would get. Why do I say that? It could be there's a lot of personal expenses that go through there. Mm. It could be that there's non-reoccurring expenses, that there was a major lawsuit that year, but you're not going to have that anymore because it was settled. Okay. So all those expenses wouldn't be there going forward. There could be, as I say, personal expenses where all your meals and entertainment the owner puts through, mm-hmm. or they have significant other who is on the payroll but never shows up. Right. So there are a lot of expenses that may not have anything to do with the business, but someone who bought that business then wouldn't incur those expenses, and thus the earnings would be significantly greater than what's being shown on the financial statements or the tax return.
Thus increasing the value of the business.
In essence, could possibly be increasing the value because you, in essence, what we call the normalized earnings stream would be greater. And this is an important part of this whole process of using your valuator in connection with the case. A business valuator who understands divorce knows that you also are going to be concerned about what is the real, true economic earnings stream of that owner for purposes of either child support or spousal support. So that valuation, what you're doing for the valuation, is going to come into play in other aspects of your case. So while normalizing the earnings stream for the value, it's important to know those things. Sure. In arriving at what the real income is to that owner from the business.
Right, because that's also then going to tie into child support and maintenance and other aspects of the divorce.
Absolutely. Yeah. And so once you get that earning stream, then we determine what is that earning stream on a going forward basis. That will help us also determine whether you use a capitalization of earnings, a single period, or a discounted cash flow. If I have a business that is a long-time standing business and it's pretty consistent earning, mm-hmm. and you anticipate that earning to be consistent going forward, right, a capitalization of a single earning period might be the correct method. Okay. But if I have a startup company or a company that has significant growth, just using the historical earnings may not truly be indicative of what that company would look like going forward. And thus a forecast might need to be used, a discounted earning.
Okay. So tell me, that's a good description of sort of the income approach.
Correct.
Other two approaches?
The other approach that is used quite a bit would be the market approach. Mm-hmm. And again, within the approach, there are methods. So within the market approach, we could use a comparable transaction method. We could use public guideline company method. And we can even look at industry methods. So what are the difference? Well, publicly traded companies. There's a market out there. Right. We can see what a share of stock of this company, that company sells for.
Sure.
Well, we can look and see, given the size of our company, we could pull comparable companies that are publicly traded, and they will give us an indication as to how to price our company.
Got it.
But you can't take that blindly.
Because that's the same nature. They conduct a similar business as a business that might be publicly traded.
Correct. It's what we call comparable. But there are differences between publicly traded companies and privately held companies. And you have to adjust the multiple for that, such as size, growth, earnings. All of these have factors which make you potentially much different than the publicly held company, and thus the multiples need to be adjusted, and that's part of our process.
Okay, and that I want to dive into, because that, unless I'm wrong, that gets into the concept of certain discounts. True?
No, it gets into right there. What we're talking about is developing that multiple that you use. You can't just pull up publicly traded companies and say, oh, these publicly traded companies sell for 10 times their EBITDA, earnings before interest, tax, and depreciation. Because your company is probably much different as a privately held than a publicly traded.
Right.
So that multiple would be adjusted based on some of these other factors. So it's the same thing when we take a look, another method, that's publicly traded.
Right.
But we also have databases out there that pull together privately sold companies.
And do those databases to some degree dictate the marketability of the company that you might be analyzing?
Well, it goes into a factor, but we also look at other factors for the marketability of a company. First of all, you have to determine whether we're valuing 100% ownership of a company.
Let me jump in there. Let's assume you have a 50% owner. Is a 50% owner viewed as a minority or a majority shareholder or some other optics?
Well, there's more to it than just looking at the percentage of ownership.
Explain that, because it does get into decision making and real true power.
Correct. I mean, do you really have what we would call the controls of ownership? I mean, for control. Just because you have a 30% ownership, but you have all the ability to make all the decisions and everything else, truly minority. It'll be minority, but have some aspects of control.
How do you ascertain that? In other words, business owner in a divorce has 35% ownership in a business, but really makes all the decisions apparently. How do you know who's making the decisions? Is it from operating agreements? Is it from the management interviews? How do you ascertain that?
Well, part of the process is that you need to look at the operating agreements. If it's an LLC, an operating agreement, partnership agreement. If it's a C corporation, you'd want to look at shareholders agreements and see what restrictions there are on the shareholders.
On their ability to sell.
Because the restriction is going to have an impact on the marketability of that interest. Sometimes there are a lot of restrictions that don't allow you to sell your interest. Right. Or the first right of refusal will have to go back to the company. And there are studies out there, what we call restricted stock studies, that have been out there that show that even as little as restrictions on your ability to sell has an impact on value. Sure. And so as part of the process of doing a proper valuation, you need to read the document and understand what are the restrictions on the ownership of that stock. There's also a famous court case, the Mendelbaum case. So it's a tax case. Judge Laurel, who came up with that decision, also put together a lot of factors that one needs to consider in coming up with your discount for lack of marketability. And one also will be, does that interest distribute cash on a regular basis? So it's, it's more than this simply taking and saying, well, there's studies out there that say the average is 35%, so we take 35%.
Right.
That would be a flaw.
So, and let me kind of jump in on this point, because where I've seen cases where each side has its own valuation expert, you've described basic methodologies that every business valuator should apply. Should apply. You've discussed the standard, at least here in Illinois, in terms of fair market. So in theory, one would presume that if I take the same numbers, the same methodologies, the same standards, I should get the same number or roughly the same number. However, in my world, that doesn't always happen. And so oftentimes what we've seen is for example, a discount for lack of marketability, for example, is something where how you analyze that on one side versus how another expert, perhaps on the other side, view that can oftentimes result in a swing in values up or down. True?
Well, obviously the other party didn't do it right. But, there's, I mentioned Judge Laurel, who wrote in this Mendenbaum case, but he also made a comment about valuators, and that, and many times valuators will come up with opinions, and it is not uncommon that their opinions will be different.
Right.
And I think the basis, though, is that what work did you do to properly support your analysis?
Right.
And sometimes when I look at valuations, it can be the variance could be because one side had better information than the other. One side did the analysis, the other side didn't.
Okay.
So there's more to it than sometimes people say, well, because you represent the non-property spouse and I represent the property spouse, that's why you have a different value. Not necessarily true. I've been on a number of cases where there's respected experts on the other side that, in my opinion, did a good job, and the valuation isn't that far apart.
Sure.
So there's more to it than just simply saying that one represents one versus the other. It's a matter of the amount of work that's really been done, and have you really reviewed the important documents? Have you really asked the right questions?
Yeah. Well, it won't shock you to know that in my 27 years as a divorce lawyer, I've never seen a case, not yet, where the valuation on the side of the business owner actually comes up higher than the valuation of the other spouse's.
Well, I must tell you that I've had one of those cases.
Did you really?
Where the other side was actually higher. It does not happen often. I have had that.
Yeah.
And I actually just recently had one where I believe you're on the other side, where the two real estate appraisers were only about 3% apart.
Yeah.
So it does happen once in a while.
Really close.
But to that end, you're not off. I mean, you do this long enough, you get to see everything.
Yeah.
And there's usually a reason for that. Yes, the property owner's spouse tends to have better access to data.
Sure.
Has a better sense for that. And so sometimes, there'll be a variance because they have information that the other side doesn't have or didn't ask.
And that didn't ask is I think on the valuator part, and that's a good point. On the getting information part, that's interesting because as the divorce lawyer in the case, we're always in the position if you're representing an individual who does not run the business, that spouse. We always say you're on the outside looking in, and a tremendous amount of work and time and resources and money go into just trying to get enough of the relevant information to you as a business valuator so that we can rely on it, knowing that the other side has all of that information within their control. So the more transparent people are in cases like this, the easier it is for you to do your job, the less legal fees are incurred getting that information, and the less the costs are, because business valuations can be very, very expensive.
Absolutely. And I think you just brought up an excellent point in that I would say the earlier that your valuation expert gets in the case, the better. Why? Again, going back to the first statement that I mentioned, that it's not just getting a valuation expert, but one who understands the divorce process,
Right.
can work with counsel. And I know you and I have worked on this on many cases where we'll work on the discovery process.
Right.
You know, assisting counsel as to what are the documents you need, how can we get them, you know, whether it's subpoenaing someone or putting together the writer that will have the information that I need as a valuation expert.
Yeah. And that, to me, even when I have clients who own businesses, I repeatedly will say to them, let's be transparent. Let's get the information to Bruce or whoever the business valuator is. You might even be on the other side, but I'd rather them not waste their money, because I have an understanding of how, like you said, the standard, the methodologies, those things. If you take that information and you just arrive at the wrong conclusion, we'll be able to figure that out.
Yep.
So it's really like wasting time and money playing hide the ball, just generally speaking, doesn't really get anybody anywhere in the process.
You know the saying they go that we'll either get it the easy way or the hard way.
Yeah, yeah.
And it boils down to money, you know. And in the end, the goal is to do it right.
Sure, agreed.
And get the best settlement based on the real facts.
Right, because it's just another asset of the marriage. We're just trying to put a number on that so that we can then have the broader conversation about what's one individual spouse's interest in that. How do we divide that up? What do we do with the income from that as far as child support and maintenance? And so the sooner we get to a point with a business valuation number as a divorce lawyer, then that's where I can do my piece in terms of really trying to negotiate a settlement.
The value of the property or the business, in many cases, it is probably the most significant asset of the marital estate. And then you have liquidity issues. So you're right, Jim. The sooner you can get what that value is, then you can focus on other parts of the case. And the fact that if done correctly, that valuation can also provide you the other information you need for the other aspects of the case as well, whether it's child support or maintenance, as to what is the real cash flow available to this marital estate.
And even in some cases, borrowing power, because we've had cases, against us, with us, in the middle, where, okay, great, we've got a number on the business now. And let's just say a hypothetical $10 million business. That's great, very valuable business. But to your point earlier, the business owner in the marriage says, I don't want to sell my business. Okay. The other spouse says, I don't care whether you say it or not, I want my $5 million. And we get into issues of how can we actually effectuate a buyout? And sometimes we have to get creative with structures, collateralizing someone's interest against, the future. And so it's a little more complicated, but as a starting point, we got to get a number on the business.
Now, not all businesses that people own are these huge companies.
Right.
But regardless, they have to be valued from the attorney's standpoint. You need to protect yourself as well as the spouse you represent needs to protect themselves. So they need a sense as to what that fair market value, and the court needs to know. Right. So not all of these, we're talking about, people may assume we're talking about huge cases, but there are those where they're not that large of businesses, but you still need that information.
Yeah.
And so we need to look at other ways to be cost effective in arriving at those conclusions.
Yeah, and actually sometimes when we have smaller businesses and we have $1 million business, or a $500,000 business, that's a little bit easier because then we can maybe offset against equity in a house, or there's a retirement money. There's ways we can kind of move the shells around so that everybody gets their equitable distribution, and you don't have to necessarily come up with a huge chunk of cash.
And those are also the type of cases where it takes the experienced attorney like yourself to realize what you have and say to the other side, let's work together, or let's get one expert, and we don't need a full-blown report. Let that expert do an analysis to give us an indication of where we're at, so that then the parties can sit down and put it all in perspective.
I tell you, the revamping of the laws within the state of Illinois, some good, some bad, certainly one of the great things that they did is expanding the court's authority to appoint financial neutrals. Have you come in? You're the court's expert now. You're not mine. You're not theirs. Because cuts down the cost, cuts down the gamesmanship and the, hey, I got to come up with a high number, low number type of thing that sometimes, you want to be concerned about. And it really, gets us to a point where we've got someone involved in the case that is giving us that number and maybe also helping us with a pathway to then dividing up that asset. So really a good change that's occurred in Illinois. It's something that we're relying on more and more.
Oh, I think you're absolutely correct there. And in many cases, it's a more efficient way to get it done. And you also then really, the expert has a lot of support from the court in the discovery process.
Right.
Because rather than the two lawyers fighting back and forth, the judge is going to say, Mr. Richman, are you getting what you requested?
Yeah.
And that goes a long way
Yeah.
than listening to two attorneys, fighting back and forth. I think it's more cost effective too.
Definitely.
And easier to then make a decision of where you want to go with it.
But listen, we're going to wrap up, but before we do, I want you to touch on briefly this concept of goodwill in sort of a personal service corporation, because sometimes you have people that immediately take the position, there's no value to my business. If I leave the business, no one will ever send business anymore, a dental practice, for example, or other personal. So the concept of personal goodwill versus enterprise goodwill, give us the 30,000 feet and above concept of how that plays into business values.
Well, in Illinois, it becomes a very important concept because in theory, personal goodwill has to be taken into consideration so you don't do a double dip. And so that we look at a business and what's the impact if that owner was not involved in the business going forward. Okay? And I guess in essence, that's personal goodwill. Is a customer or the client coming back to this business because of that individual, or are they coming back because of the enterprise?
The enterprise being the name, and
the name could be the name, it could be the product, it could be the infrastructure that's in place. Are they coming back because of that, or are they coming back because of the individual? For example, in a law practice, people are coming to you, Jim, because of you. If you left, they probably wouldn't come back. They would say, "Where is Jim?" and go with Jim. That's personal goodwill. Right. Every business is different. Even sometimes when we think that it's all personal goodwill and the property owner is always going to say, it's only because of me we have this business.
There's no value.
And the fact is, in some cases, it could be that the business was started and was created because of that person, but they built such a powerful infrastructure now that that personal goodwill is now enterprise goodwill. That people now go there because they know the name of the company,
the brand.
They know the product, they know the other people that work there, and that's why they're there. So it's not a matter of off the cuff deciding is it personal or not. It again is really looking at and getting an understanding as to what really generates the business of that company.
So last point on the goodwill piece, true or false, your analysis as a business evaluator, when you're looking at that question, goodwill, to agree somewhat subjective?
I don't know if I would use that term subjective. I know
How
that
about this
when we
term?
do my reports, my value is after consideration of personal goodwill.
But the analysis of goodwill may be variable. Better word than subjective. In other words, I could look at the same numbers, same business, and I could determine that the goodwill, the personal goodwill in this valuation is very high. You might look at it and acknowledge it, but maybe say it's relatively low. And if we have a different view of goodwill in that same value, that could adjust the ultimate value number. True?
I think understanding the impact of personal goodwill has an impact on your value. So I would leave it that making sure that you ask the right questions and analyze the right facts so that your conclusion on that is supportable. And many times the impact of the variance of the two experts is really based on that. And that could cause a difference in the conclusions of value.
That was a very political answer, very almost a non-answer, but I think everybody gets it. Well, listen, I know we're running short on time. I really appreciate you coming in. For any of the viewers or listeners that might be in a situation where, for whatever reason, they need a business evaluator, forensic accountant, how can they get in touch with you? How can they reach you?
I can be reached at either my cell anytime, 847-537-3200, or at my office, 312-863-2417.
Is there a website where people can learn more about you and your company?
Absolutely. They can go to Mazars, MAZARS, and from there they can either look up Bruce Richman, Richman, or just Google Bruce Richman.
There you go.
It'll come up valuation or divorce somewhere along the line there.
Awesome.
I do have a book out on all the tax and financial aspects of divorce.
What's the name of the book?
Tax and financial aspects of divorce. And again, it's on Amazon, and you can Google that.
Awesome. Bruce, I really appreciate you coming in. Thanks for your time.
No, I appreciate the opportunity.
Great. And if we can ever be of any help to you, don't hesitate to call us regarding any cases, whether there's business valuation involved. Thanks again for listening. Take care.